terms. You're pretty much buying one thing, exchanging it for the other for a profit, or you're selling one thing, exchanging it for the other to make a profit. You can make money if you buy something in trading and then sell it, or you can make money in trading if you sell something and then you sell it at another price point. More on this later in the video. And this isn't anything new. Us humans, we've been actually trading things for thousands of years. I'm talking about back in the day before even money was a thing. We were exchanging cattle for wood, or we were exchanging wood for some fish. Some people had goods that other people didn't have, so we were trading and exchanging one thing for another. Just in different amounts where one person was gaining and so was the other person. So it was an equal exchange because both the people had to do it. One person needed fish, the other person needed wood. One person needed the wood for fire, the other person needed fish to eat. And if you have an excess of each, instead of pretty much you're not using it, you exchange it for somebody else for something that you need. So now in Forex trading, we're obviously not trading fish for wood. We're trading one currency for another currency. For example, the euro being traded for the US dollar. The US dollar being traded for the Great British Pound. Have you guys ever gone to the airport and as soon as you get off of the plane, you see these big exchange money spots that you can pretty much go to, and if you're in a different country with a different currency, you can exchange $100 for $100 of that currency's actual physical dollar. We have all actually participated in the currency exchange participation, and this currency trading happens every single day. I'm talking trillions of dollars. Yes, trillions, not millions, not billions, trillions of dollars that are being exchanged every single day. To have the exact number, it's actually $6.3 trillion is moved in the market every single day. So when you're trading the foreign exchange markets, you're trading one currency for another, but you're not actually buying currency tangibly. You're not going to get this money in your bank account, or you're not going to hold it in a reserve account or in a different exchange. You're not doing any of that. You're simply betting if price will be going up or if price will be going down. You're essentially betting that the currency will get stronger or weaker versus the other currency. And the way that this works is by fundamentals. It's by the government, by the interest points of that country, by the banks behind that country and their funding, by the economy of each and every country. And if the country gets stronger than another country, that currency will rise, making it stronger than the other currency. So there's a spread there that it will go up in value and you make money on that spread. And let's say if a currency gets weaker than a different currency, then there's a spread that you can also make money on that as well. So for example, let's say that the US has had a recession and the euro is actually in a booming market. That means that the US dollar is going down and that the euro is going up. This is where you would want to buy the euro and where you would want to sell the dollar, because the market is clearly bad with the dollar. So you want to put sells in that the dollar will go down, and you want to put buys in that the euro will go up because it is doing better than the dollar. It's almost a win-win scenario because the fundamentals are driving price down for the US dollar and driving it up for the euro. Now, bear in mind, you're not only just buying the euro or you're just only selling the dollar. You can't do that. You have to bet on a currency pair. What is a pair? Well, it's, two things. It's like when you have a pair of shoes, you have your left shoe and your right shoe. If you have a pair of sandals, you have your left sandal and the right sandal. So when you have a currency pair, you have one currency pair and then another currency pair. And what they're doing is they are together battling each other. Who gets stronger than the other? Who's driving price up and who's driving price down? So for example, let's use Euro USD, which is the most known pair in the whole entire foreign exchange market. It is the most traded currency pair in the whole entire market. It has the most volume and the most movement, meaning that there's more opportunities and how you can actually capitalize off of it, but more on that later in this video. So when you're actually trading the foreign exchange market, you have to trade on a currency pair. Euro USD. If you were to buy Euro USD, you are betting that the euro is going to get stronger than the dollar because the euro drives price up. And if you were to sell Euro USD, you are betting that the dollar will get stronger than the euro. And that is because in the Euro USD pair, the euro is the base of the currency pair, and then the USD is the quote. So basically the euro is what drives the price up, and then the USD is what drives the price down. So if you see the price going up, that means that the euro is getting strong. And if you see the price going down, that means that the USD is getting strong. So if you want to bet on the dollar getting stronger, you have to sell Euro USD because the US dollar is going to get stronger than the euro. And if you want to buy Euro USD, you are betting that the euro will get stronger than the dollar. And this works for all currency pairs across the market. For example, GBP USD. It's the Great British Pound versus the dollar. So if you buy GBP USD, you are betting that the pound will get stronger than the dollar. And if you are selling GBP USD, you are betting that the dollar will get stronger than the pound. And in the foreign exchange market, there's thousands of pairs. I'm talking literal thousands. Like you can have the US dollar against the Mexican peso. You can have the Mexican peso against the Russian dollar. And that is the beauty of this market. There are so many different types of opportunity because there is so much more money being moved than the stock market, than the futures market, than even the crypto market. There is $6.6 trillion being moved every single day because this is a market of the whole entire world, of all the currencies in the world combined in one single market. Compared to the New York Stock Exchange or US 30, you're only dealing with the companies inside of the United States, which can only be so big. So that is pretty much a very entry level of what Forex is. Now, there is many markets out there like futures, commodities, cryptos, options, and there's great opportunities there, but nothing compared to Forex. So now let's actually dive deep into actually how this market works and how you can learn everything you need for you to be able to go battle this market every single day. So now that you've seen that there's different types of currencies that you can actually trade all around the world, now there's actually different types of formats that you can trade. There's different types of way on how you can approach these different types of currencies that they all move very different. So to begin with, you have scalp trading, which is known as the lower time frame traders. These are the traders that have the faster movements, that they're in the market a lot less time. They have a higher win rate, but a lot less of a risk to reward. These are traders that usually are kind of stuck in front of the market the majority of the day or the majority of the night, that they have to dedicate hours sitting in front of the computer to just find one little good opportunity because they're only in the market probably within 1 to 2 hours of the market movement, which they can either be winning very fast or losing very fast. And some scalpers can either enter 1 to 3 trades every single day in order for them to make some money or just make back losses from the previous day, because the majority of the scalpers will lose the majority of the time because they're taking a lot of trades constantly. And scalp trading is actually the most attractive type of trading that beginners kind of approach to it because they just passionate about trading and they want to be in front of the charts as much time as they can. So they approach scalping thinking that's going to be the best way for them to make money. Next, it leads me to day trading. So I'm sure we've all heard the term, oh, he's a day trader, or I know a day trader. Well, it's actually a very common term because it's what the majority of the people that work a 9 to 5 attempt to do. Because for you to be a day trader, you pretty much have to be in front of the markets while you're in a job. So people kind of treat it as their side income. And day traders are usually in front of the markets a little bit less time than scalpers, but they are definitely taking a lot less trades. They would be taking maximum 1 trade every single day, because anything more than that, you fall into the category of scalping. And day traders are a bit more selective when it comes to the trades, and their trades can last anywhere from 1 to 3 days to play out. Unlike the scalpers, that their trades can last anywhere from 1 to 2 hours. So day trading, your trades are actually being held 1 or 2 days compared to scalpers, which is a little bit of a time. Next is going to be swing trading. So swing trading is actually a approach of the market where you are swinging the market, meaning you're just chilling. You're going to be in maybe one position a week, maybe two positions a week if you find a good probability trade, and you'll hold it throughout the weekend. So you'll be in the position for anywhere from 4 to about 8 to 10 days. And these positions usually run a lot longer, giving you a lot more profit. And you actually have to do a lot less work. You're probably in front of the market for 1 to 3 hours every other day. You don't have to be involved in the market that much, because as soon as you enter a trade, you're pretty much letting your trade ride until it goes in your direction or against you. But swing traders are taking a lot less trades, but they are risking a lot more compared to the day traders and compared to the scalpers. And swing traders usually tend to have the highest win rate because they're being very, very selective on the type of trades that they take, because they're only taking anywhere from 1 to 2 trades a week. And then next is going to be position trading. So positions trading is a trader or investor that pretty much enter a trade with a long-term vision. They want to be in the market for anywhere upwards of a month, and they are not looking to liquidate their position anytime soon because they're treating it as a investment, as a position that they're entering in the market. So they're prepared to be involved for about 1 to 2 to 3 months to just simply have their trade get as much profit as it possibly could be. And position traders or investors, they'll probably take 1 to 2 trades a month, if any. Usually they stick to 1 trade a month because they're looking at the market long term. They're not looking to have any short-term gain, and they're looking to minimize their losses as much as they possibly can. And investors and position traders are actually the ones that lose the least, because even if their positions go into a loss, they're going to continue to hold it long enough until it goes into profit. And if you hold a trade long enough, it will go back into profit. So as you can see, every single format of trading actually scales up on the amount of time that you're actually holding a position. A scalper is involved in the market anywhere from 1 to 2 hours a day. A day trader anywhere from 1 to 2 to 3 days in the market. And you have a swing trader where it's anywhere from 4 to 8 to 10 days. And then a position trader where it's upwards of a month. So every single different type of format in trading, they are actually holding their trades longer, but they're actually taking less trades. So as the formats, they scale, so does the time they hold the trade, but the amount of trades they take is a lot less. And all of these different formats you can actually apply to all of the markets. You can apply it to foreign exchange trading, to commodities, futures, options, crypto, everything that has pretty much a chart with candlesticks that go up and they go down. But the best one, and the one where I've had the best experience and the most success, is going to be Forex trading. That is because it offers the best things that no other market can offer. It has 24/5 access, meaning you can trade Monday through Friday, any hour out of the day. So if you work a job, you can trade when you get out of your job. If you're up late at night, you can trade late at night. If you're up early in the morning, you can trade early in the morning. Compared to, let's say, options or stocks, you can only trade 9 to 5, which kind of sucks, because if you have a job, you can't get involved in the market. You're simply limited to what you can actually do in the market. The next reason why it's my favorite and why I got involved is because the entry barrier. It's impossible that the currencies of the world simply disappear from one day to another. If that happens, we're in a big problem, but that will literally never happen. Compared to a company in the New York Stock Exchange, they can simply just go bankrupt one day or get sued and you're done for. Or a crypto can pretty much get rug pulled and all your money is gone from one day to another. The currency exchange market is here forever, and it is going to be here forever. Countries run on these currencies and they need to do that for it to keep going. For that reason why the currency exchange market only gets bigger year after year, and the opportunities are going to be there forever. And adding up to that, you can actually get involved for free. You can actually test and apply the markets and try and figure out if it's going to go up or down with fake money. You can use demo money to test your skills and learn it before you actually put real money at risk. And when I was trying to get involved in the crypto market, this simply wasn't a thing. They don't allow you to use this with fake money. It wasn't even an idea. Versus in the foreign exchange market, not only can you access it whenever you want, you can actually test it with fake money, which is actually really cool. And if you don't know what demo is, it's pretty much simulated markets. It's demo. It's not real money. It's paper trading, fake trading, where they just give you fake money in an account where you can get in and pretty much go test it out. So if you want fake $100,000 and you want to test out your skills, you can do that. If you have $5,000 to put into the market and you want to test out your skills first, you can create a fake account with $5,000, which is actually amazing. So that way you can actually see how far you can get with demo money, so that when you're ready to deposit your own money, you're ready. So now that we understand how the Forex market works, a very simple way, we have to understand how can we actually execute into these markets. What platforms are required? What platforms should you look at? What platforms shouldn't you look at? And this is where it can get a little complicated if you don't have the right video. And that's why everything is inside of this video, which is going to teach you the only platforms that you're going to be needing in order to be able to execute trades in the market successfully. Now, there is hundreds of different platforms. There is thousands of different people directing you to different places, but these are the only platforms that I have personally been using for the last 7 years trading in the markets. And I have never ever needed anything else when it comes to actually executing in the market other than these platforms. And I've made probably around $10 million on just using these two simple platforms. You do not need anything else other than these two platforms that I'm going to be explaining now. And then obviously a third one that you will have to do your own due diligence on, but this is going to make sense in just a second. The first platform is going to be TradingView. So TradingView is pretty much what its name says. TradingView. You're going to view the trades on this website. This is a well-known website, I think used around about 80 to 90% of the market. And this is where you're going to be actually looking at the charts. This is where you're going to be looking at the markets going up, at the markets going down. This is where you're going to look at the markets, for example, Euro USD, how we were setting an example, GBP USD, GBP CAD, so on and so forth. Now, this platform is strictly and only to simply just look at the market. This is where you're going to be identifying if you're ready to buy or if you're ready to sell. But you will not be entering a buy or sell on this platform. It's something that the platform offers, but I personally have never used it. Neither has anybody in my community, or I've heard anybody of ever using it before. It's something that they offer, but I personally rather stick to the different options that I'm going to share with you now. So TradingView, to keep a very simple example, is just somewhere where you can view the charts. And this is a platform where you're only going to be looking at stuff. You're not going to be executing other than just things you will be drawing on the charts to identify if there's a high probability of it going up or a high probability of it going down. This is where you will be doing your charting. This is where you're going to pretty much spend, I'd say 90% of the time that you're in front of the markets will be on TradingView. Because when you actually execute a trade, it will be on a different platform. And you're not going to be looking at the numbers on the screen. You will simply be looking at the charts, because what's on the charts will reflect on the numbers on the screen, which will be on your phone or your computer, wherever you decide to actually take the trade. But TradingView is simply just so you can see the charts, whether they're going in your favor or against it. And the simplest analogy that I can put is like you right now watching this video. You're watching this video to intake the information that I am giving you, so then you can learn and then you can go execute in the market. But you're not executing a trade on YouTube. You're not doing anything on YouTube other than simply getting educated and absorbing the information that I am giving you, or that you're simply watching on YouTube. And you can watch the video in a bunch of different formats. You can watch short-term videos, you can watch long videos like this one, you can watch it in theater mode, in full screen mode, or on your phone. So there's different types of ways on how you can intake this information. It's the same exact thing with TradingView. You're looking at the charts in a bunch of different ways so you can intake the information, so it can tell you if you're ready to buy or if you're ready to sell. But you're not doing anything other than just looking at the information that the market is sharing with you on TradingView. So let me actually take you to TradingView just so you guys can get a very simple insight of what this actually looks like and what to pay attention to and what to not pay attention to, because this can almost be very overwhelming at the beginning and information overload. And trust me, it happened to me and I almost kind of got intimidated and didn't even want to look at it too much because I just didn't know what to look at. So I'm just going to explain to you right now what are the only things that matter when you log into TradingView very briefly, and then you're going to see what you shouldn't be paying attention that, because honestly there's a lot of stuff here that you really don't need. So diving into TradingView right now, this is as soon as you log in, this is what you will be seeing. You will be seeing pretty much to your top left hand side is your accounts, and you're going to see all of these tools that are randomly right here to the left hand side that you probably have no idea what the use is for. But everything inside of here is basically a tool that you can use to your advantage to chart up the chart. It's simply things that you can use to put on top of the chart so you can create an edge on the trade that you will be taking. You will not be needing everything that is in this toolbox right here. This is absolutely excessive, and you only need to use about 7 to 8 tools out of everything this platform has to offer. So if you come back here to TradingView, this is just a simple ray example that I have just showed you, and it is really not necessary at all. Within this section, you have many different types of lines. You have the info line, the extended line, trend line, horizontal line, all these lines that literally I do not use, and you will never need to use it. You will only need to use 3 things from this line section, and that is going to be the trend line, the horizontal line, and the horizontal rate. So if you'd want it, all you have to do is put a little star. When you put a star, you will notice that it will pop up on this box right here that is going to pop up in front of your charts. This is going to be your favorited tools out of all of the ones that the platform has to offer. This is so you can pretty much filter out the only things that you need, because again, there's many things in this platform that you do not need to pay attention to, and there's many things in this platform that, as of today, being a multi-millionaire trading on this platform, that I have never used, meaning you will never need to use them either. So you just simply, I'm going to explain to you what they are, and don't even get curious on learning what it is. Simply just know that it's there and know that you will not be needing it ever to become successful in trading. So moving on, you have the channel section, and this is where there's different types of channels, pitchfork, shift pitchfork, all of these things that make absolutely no sense. And all you have to do is just completely ignore it. You will not be needing anything inside of the line section other than these 3, because this has no indication to creating an edge in the market, how I have been trading for the last 7 years. Now, there might be some strategies out there that do, but the majority of them don't really use it, especially mine. So when it comes to here on the second section, you're going to have your Fibonacci area, where there's about 10 different types of Fibonacci's, and we will be using absolutely 0 of these Fibonacci's. These are all different types of random stuff that just make your chart look weird. Like, look at this. You're gonna tell me you can create an edge with this funnel or this fan, whatever this is even called? No, it simply doesn't make any sense. It's just accumulating your chart. It's putting mathematics behind it that honestly, it's not needed when it comes to trading. All you will need when it comes to trading is read